we get that perfect storm during a recession of an increased demand for all the things that are happening in the economy, and then the supply chain, which is being shut off, choked off, or at the very least, slowing.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey everyone, welcome to today's show on Wealth Strategy Secrets. We've got another awesome show for you today. Today we're joined by Scott Myers. Scott and his affiliated companies focus on the acquisition, development, and syndication of self-storage facilities nationwide. He currently owns and operates over 2.4 million square feet and over 14,000 units nationwide. His education organization, selfstorageinvesting.com, provides courses, tools, live events, and mentoring to help others launch their own self-storage business to enjoy a lifestyle, as he has coined, free from tenants, toilets, and trash. His various companies fund and build 4 to 6 houses each year in Mexico by taking his family, staff, and clients on an all-expense-paid short-term mission trip. Scott, my friend, welcome to the show.
Dave, so good to see you again. Thanks for having me.
You bet, Scott. No, it's always great to connect, and always enjoy our discussions since we connected last year. And for the audience who isn't familiar with you, or what some of your initiatives are, tell us how it all started for you and really getting into the space. Yeah.
So I think, like many people, when you start actively investing in real estate, it starts usually with single-family houses, and that was it. That was the first one. I watched the Carlton Sheets program on how to invest in real estate many years ago, and bought his home study system, and then purchased a single-family house, and it was a fixer-upper. Of course, we assumed the mortgage on the property, and then we fixed it, we rehabbed it, renovated it, rented it out, and refinanced it. And the BRRRR method, before it was called the BRRRR method. And then we moved on to buy 2 more after that with the proceeds from that one, and we were off to the races. And then we found ourselves, my wife and I, as partners in the business, that we didn't really have the cash flow and the freedom, the free time that we wanted in that side of the business. And so we thought, well, we just needed to work smarter and a little bit harder, and then economies of scale would fix this. And so we got into multifamily. We began investing in multifamily projects, and at that time, all that did was really just kind of increase our headaches, and we had less free time and less cash. And so at this point, we're looking to make a pivot. Still love real estate for all the reasons everybody loves real estate, because we can leverage to buy it. You can't do that with any other investment. It appreciates if you do things right, and you can depreciate it for tax purposes. And so there's really no other investment on the planet that works quite like real estate. We just didn't like the tenants and the toilets. And so when we look around the landscape, that leaves parking lots and self-storage, and I began to look into self-storage, and the more I looked into it and researched it, the more I liked what I saw. If people don't pay you, well, then we lock them out, and then we sell their stuff off, because we don't have to adhere to habitational laws of real estate. We are in the warehousing side and lien laws, which protect us. And then our turns, when somebody moves out, or if we have to auction them off, what we get back is a metal box on a concrete slab. And we blow it out and move on to the next person waiting in line for our units. And when we look at the life cycle of self-storage, it does extremely well. It actually does better during a recession than it does during inflationary periods or boom times. We get the hockey stick effect. It goes up and to the right, because when the economy turns sour, businesses downsize, and they put their additional warehousing and stock, and whether it be any type of cost of goods in their cost of operations, and including any office furniture that goes into storage until things turn back around again. Same for individuals. They move back in with each other. They move back home with their parents, and they put their things in storage, and things turn back around again. And so we actually do better during a recessionary period. And so for all of that, it has the lowest loan default rate, lowest loan loss rate. And so we decided to make that pivot and sold off all our houses, all our apartments, and we do and invest in nothing but self-storage at this time. So since then, as you mentioned, we actually have surpassed now 4 million square feet of self-storage and over 25,000 units nationwide. We just had a very massive year, and then just a massive couple of months here that has increased our holdings. And so we syndicate projects along the way. As you mentioned, we can't grow. Nobody can grow to that level without bringing on private equity. And we're also seeking that not only here in the United States, but then have been doing that internationally as well. So that's the short or the long version of how we got to where we are now.
Yeah, that's really awesome, Scott. And before we jump into, some of the specifics of that, so we can kind of help investors kind of understand the asset class a little bit more, I also, really love the charitable work you're doing. So tell us a little bit about your foundation as well.
Yeah, so in the very beginning, my wife and I, we got into real estate because we wanted to have some free time to raise our kids and to be able to do the things that our parents didn't do and couldn't do for us while we were growing up. And so as we started our business and launched it, first of all, in the houses and apartments, we never would have got to that place that we are in self-storage, that we have that freedom to be able to travel because we don't have the tenants and the toilets to take all of our time away. And we had the cash flow to be able to go and spend several months out of the year off the grid on the mission field and visiting various parts of the world. And then that led us to building houses in Ensenada, Mexico. So we do 2 trips a year. One in the summer / early spring when school gets out. We take these family-friendly mission trips for, again, our staff, our family, friends, coworkers, partners, our students, and we pay for them to go on these trips. We pay for the entire trip, including the house itself and all the costs of transportation. All they need to do is get to San Diego. And we've been doing this for several years now, and we build roughly 3 to 4 houses each time we go. And so we're doing anywhere from 6 to 7 houses per year now, so going on trips twice a year, and then looking to ultimately, Dave, the goal is once we go through this next cycle, if you will, in terms of a ramp up and buying more storage facilities, and then perhaps selling off or refinancing in 4 to 5 years. That may be our last go around, and then we plan to flip the script and spend about 80% of our time on the mission field and 20% just running and managing the business.
Wow, that's excellent, Scott. So that was really going to be my next question for you. As you know, we talk a lot about having a wealth strategy, right? And kind of doing that lifestyle design, for yourself. So it sounds like you guys have gotten some good clarity in terms of the vision and, where you and your family want to head. But can you articulate anything more about your current vision and wealth strategy for yourself?
Absolutely. I think, at least I would hope. Unfortunately, we do see that there are folks that do fly a little more by the seat of their pants. And as entrepreneurs, I think by nature, we're kind of that way. We're a little more optimistic, and we don't always have a plan. But we have since day one. As soon as I say that, we've taken some pivots along the way. And every time we come up with a plan, or maybe a long-term 10, 15, 20-year plan, God sends us in a different direction. And so we just follow that and been obedient to that. But the ultimate goal right now is, we plan this to be our last hurrah, if you will. And so call it that 5 to 7 year mark where we know we'll go through another economic cycle to ramp up our acquisitions and developments and stabilize all those assets, and then either refinance and hold those or sell those off. And each one we will look at systematically as to what the exit is. That is ultimately, that's the plan. Anytime we head into one of our projects, whether it be a $2 million project or a $20 million project or a $100 million portfolio, we always enter it with the exit in mind. And so beyond that, we do have a number, if you will, and we feel that we're going to reach that at the end of this next economic cycle. And then, my kids are scattered all around the world. One's in Amsterdam right now, one's in Costa Rica heading to Africa, and the other one's in Phoenix, which is where I am right now. And we don't know where she's going to end up. But the plan is to have the ability, have the resources, the time, the flexibility, and obviously the finances that it takes to be able to travel around to wherever our kids are, but then also to continue and really upgrade and enhance our mission efforts that we're incurring right now.
Yeah, I really love it. I think it's like when you peel back the layer really of, building wealth and finance, right? Everyone talks about, numbers and everything. But when you kind of really peel it back, it's really means something deeper. right? It's all about having freedom of money to do those things you want to do, freedom of purpose, you rearranging your purpose to support, the mission. It's also freedom of time, freedom of location to be where you want to be with and who you want to spend your time with. So it sounds like you've architected a really nice plan for that. And I think that's inspiring for folks.
Thanks. That's the goal right now. And so we'll see what the next 5 to 7 years looks like.
Yeah. So let's jump into storage for a little bit. And I think, at the time of this recording, right, it's mid-February, potentially an impending recession, however you want to look at it, whether we're in one, we're approaching one. And self-storage has been traditionally has fared, very well, as you pointed out, during prior downturns in 2008 and prior other cycles. So, why don't we talk about some of the specifics around, why does this asset class perform better, right, than, some of the other private equity assets during tough times?
Yeah. So Dave, we're, the saying in our industry is that we're in the trauma and transition business, in the trauma and transition industry, and we service those that are in transition or that are experiencing trauma, death, divorce, bankruptcy, recessions. You name it, that usually necessitates a move, or in many cases it does. And so when people are getting ready to move, whether they plan to do so and they're upgrading their house or moving from one part of the country to the next, well, they're going to stage their house and they're going to put all the things in storage to make it look like it has more room and to get rid of all the clutter so that it looks and shows well before they move. And then when they get ready to move, they're going to use storage usually to put some things in until they ultimately get to their final location, and then they're going to typically use storage again until they get everything out of there. We've seen over the years, the baby boomers have done extremely well, and so long as they've done well, that they're creating more demand by having homes in two different places. So one in the north, one in the south, and then when it comes time for them to leave their home in the south to go back home, and they're going to rent it out, they will put their stuff in storage, and then sometimes it just stays there a little bit longer as we head into a recession, or ultimately, if they're getting ready to sell that house, then they still have those 2 units that are in both locations. So whether that's because they have to or because they want to, either way, we've got the industry covered, or we've got the recession and the inflationary periods covered. But ultimately, what we see is that, yes, when we fall on hard times, and the pandemic was a perfect example of that, Dave. It mimics exactly what happens during a recession. And I've been through 2 now. This will be my 3rd that I go through, and we go through this phase where people, immediately when Lehman Brothers fell on the last one, or when there was a lockdown in the pandemic, well, then, immediately there was businesses that went out of business, and they had to put their excess inventory, furnishings, if you will, office furniture into storage while they either lost their lease, subleased some space, and so they put their excess into self-storage. And then also when individuals, again, when they fall on hard times, if they move back home with their parents or move in with each other, they'll put the extra stuff into storage until things turn back around again. At the same time, then we have lenders that usually put their pencils down for a while. They're going to step back. They're not going to take on more risky or speculative projects like a self-storage development or really development of any kind until they see how things shake out. And that's the place where we find ourselves right now, in this inflationary, high interest rate environment, where many of the lenders aren't looking at projects. And at today's interest rates, some of these projects we've hit the pause button, or they've just gone by the wayside. And all the same time, we're getting this pent-up demand for self-storage, and so occupancies are rising, and the rental rates obviously are rising as well. So we get that perfect storm during a recession of increased demand for all the things that are happening in the economy, and then the supply chain, which is being shut off, choked off, or at the very least slowing because some of these projects just don't work any longer. Add to that the fact that now we're a very transient society. We learned during the pandemic that, employers learned that their folks can be very productive and work well from home. And so now they're sending them home, or they didn't ask them to come back, and they're reducing their office space. And now people are free to move and go to sunnier states. That's why folks are moving to Florida in droves, and Texas, and the Sun Belt states, or in some cases just back home to be with a family. They moved away for a little while, and they're choosing to move wherever they want, and because they can do business from wherever they want. We also see during a recession that many folks will be forced to start a business. And when you start a business, the least expensive space, if you're going to be selling anything, even if you're in the eBay business or an Amazon drop shipper, you're going to run your warehouse in a very small space, which is your garage or your basement, until you run out of room in the garage or your basement, and then those goods go into self-storage. And so there's a number of factors and a reason why self-storage does so well during a recession. And like clockwork, it happens every time, and we're starting to see it as we head into this next one as we speak.
Yeah, interesting. Is there anything different around this time around, especially with respect to the current interest rate environment?
Mm-hmm. Yeah, so every recession is a little bit different. In 99 and 2000, during the dot-com crash, unemployment wasn't as high. The GDP, dipped down quite a bit, but that was a pretty quick turnaround, and that was really caused by the tech sector. When the bubble burst. At that time, however, to get the economy going again, the Community Reinvestment Act was put into place, which meant that loans were being made to folks to be able to spark homeownership, and so they relaxed the lending requirements in order for people to get these government-backed loans to buy houses. And so for us, our tenants left our houses and our apartments in droves to buy a house because they could for the first time in their lives, and who could blame them? And then you fast forward to 2008. Well, to make a long story short, if you've watched The Big Short or if you just paid attention, that's what caused the Community Reinvestment Act and all those loans where people should have really had a loan for a house, and even the shady projects that were undertaken. Well, we defaulted. Lehman Brothers fell, and the economy fell into a recession, and there was a housing bubble that burst that time around. And then you tack onto that the events of September 11th, and unemployment skyrocketed at that point. GDP went down even more, and that was a longer, deeper recession. Well, this time around, it's been a slow burn, but it's been caused by just high inflation. We've still seen unemployment is really very low right now, but we're just seeing the consumer price index is going up of things, and that is causing again a slowdown in the economy. And I think once more numbers come out in terms of the consumer price index and the results of Black Friday, even going back to November of 2022. Then we'll see a slowdown in the economy. And of course, we're only one. We got a war in Ukraine. We've got natural disasters and things occurring that cause the financial markets to get skittish and people pull out. And we're really, really close to just one of those, really kind of taking us down, if you will, and sending us down that path where consumer confidence goes to an all-time low, and they pull back from the stock market and in droves, and then we head into the next recession. So that's my crystal ball, I guess, the way that I see it and where we're heading into right now. The difference is that it's just been more of a slow burn, and interest rates are the ones that are sparking that. And I think it's the consumer price index and confidence that is going to draw us into this next one.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
Yeah, makes sense. And so help listeners understand really from an operational perspective, two things. Let's first talk about competition. Because it's interesting, if you're driving around in any high growth market, you're basically seeing self-storage facilities pop up on every corner. Some of them literally right next to each other. So tell us, what is the logic that goes into, where you're putting facilities, where are they located, what markets that you're in, and so on and so forth.
Probably the most common question that people ask of me when they learn what I'm doing, their curiosity, and I'm so very valid, Dave. And it's always interesting to me when I think I need to come up with like a better tagline when I'm either at a cocktail party or on the sidelines of a soccer game when somebody asks, because it's usually the first thing out of their mouth is, "Oh, really? So do you mean, or it's you mean you buy them and then you sell the contents like Storage Wars on TV?" No, we own the facilities. We actually buy the facilities and develop them all over the country. I said, "Oh, well, I see them all over the place. Is that one down the road yours?" And sometimes yes, sometimes no. But gosh, there's a lot of competition. Every time we turn around, there's one of these things going up. And are you making any money at this? And I think, well, we wouldn't do it if we weren't making money at it. And nobody ever says that when you see another Starbucks go up, or if you see another McDonald's go up, or anything else for that matter. If somebody says they're a doctor, nobody asks if you're making money at it. Don't we have enough doctors in the world? And we look at self-storage, it's the same. I mean, we've seen a huge boom. It has been the fastest growing sector of real estate for the past 30 years. We develop more self-storage facilities than any other form of commercial real estate. And so that being said, yeah, we see them go up all over the place, but that doesn't mean that there are developers out there that are taking on, the loan risk, the construction risk, and then a lease-up risk if this project doesn't work, if you didn't have solid numbers behind it and a feasibility study with consultants and market data. That is everything that we do anytime we buy or develop a facility. It is driven by a solid feasibility study and a market study, as well as a plan to move forward based upon historical track record of ours, the market, existing facilities, and a lot of hand-wringing that goes into this, and underwriting, and then performing very conservatively to make sure that these projects work. And so to that point, we're not doing it for fun or building it and hoping they will come like they used to do back in the 70s or 80s when the industry was young. Right now, there's really too much at risk, and then any appraiser would kill a project or feasibility study, consultant or a lender would if the numbers didn't work, and then we would pull out as well if we saw anything. And so the reason why we're building so many, and you see so many, Dave, and anybody else out there, is because there's a demand for it, and we're filling them. 7 square foot per capita is roughly an equilibrium in a market, and a market is roughly a 5-mile radius. So you plop me down anywhere in the country, and I can do a market study within about an hour or two, and then tell you if it's worth at least pursuing to move forward. And in some cases, we know it's immediately a yes, and it's a go forward if we can find a plot of land that makes sense and get it built for the amount of money that it would take in order to make it profitable.
Yeah. And Scott, are there any particular markets that, you're favorable to?
So, we're fairly market agnostic. What we tried to do, however, is once we have developed a facility, Dave, or once we buy one in a particular area, then we try to blanket that area and get that economies of scale, because that goes across our marketing efforts for the market. We can then spread that across our direct management staff that is overseeing not just one facility in a market, but then they can oversee the 3 property managers or property management companies that are in that market. And so, as we continue to build upon that, then the overall cost at the operational level goes down for us. And so that has always been our approach to a market. Outside of that, there's certain market factors. There's areas where the population is decreasing dramatically, and we're seeing a huge migration shifts over the years. Like Flint, Michigan, Detroit, Michigan, they've lost 40-50% of their population. Those are markets that we're going to stay away from. And others, like as we mentioned, we operate mostly in the Sun Belt states, and throughout the Southeast is our concentration of projects right now, and in Arizona, which is where I am right now, where we're going to go visit one of our developments here. And those are the areas that we're focusing on, just because of the migration of folks. And anytime there's growth, that's obviously good for a service-based real estate investment like ours.
Sure. And from a business model perspective, a lot of investors are familiar with, let's say, multifamily syndications, right, where you've got a value add opportunity. You might have a new development or a Class A, right, in that business model, how they'll, add value. Talk to us how that's similar, different to, self-storage projects that you're working on.
Yeah, very, very, very similar. I'm coming from the multifamily arena and exiting that and coming into self-storage because there are truly more opportunities to create value in self-storage than there are in all the other asset classes. We have ancillary income streams that we can add to the facilities, like offering tenant insurance, as well as eBay services, pack and ship and drop shipping services and receiving, and then also document services for storage, as well as delivery and shredding services. The addition of retail, selling locks, boxes, and the moving supplies. Then adding additional buildings and units, and then an income stream on top of that is the greatest way to create value. But it's much easier and faster when you add a 10,000 square foot building, Dave, with 100 units in it versus a multifamily in which you're only getting several, or a dozen or so units out of that, because when you raise rates, which we can every 30 days if we want to, versus an apartment, you can only do once a year when they renew. It just gives us more flexibility, the opportunity to, again, add on all these profit and income streams, and then raise rates at a quick clip. Some of our facilities, we've raised rates 20 to 25% when we move in, and then we've had regular rate increases every 3 to 6 months until we get up to market. Because we have the ability to do so. And again, just the low loan loss rate, because when people move, our accounts receivable is very low, just because we have the ability to sell their stuff and recoup our back rent and late fees. So adding on to the facilities and all the profit centers and income streams, we found we're able to move the needle much faster and at greater lengths than we were ever able to do in multifamily.
That makes sense. And do you have a preference, right, in terms of, doing that value add with, say, an existing, maybe buying from a mom and pop type operator and adding all those additional income streams to it, or doing, a brand new development type project?
Yeah, so we like both. Of course, the greatest value add is that if you buy a piece of dirt and then you build a building on it and then put an income stream on it, that is the greatest value add, all things being considered. But the quickest to be able to cash flow is to buy an existing facility and then add in the retail sales and start offering a one-time admin fee where they never had before, offering the U-Haul or other third-party truck rental services where we don't pay for anything, we just provide the service as an agent for them, and add all those those pieces in where they didn't have the income streams previously, and then also layering on the technology piece to that, where we can reduce our payroll by running our facilities unmanned with the kiosk if we choose to. And then instead of going around and putting locks on individual units, we can use electronic key fobs and electronic locks to be able to overlock the units when people are behind in rent. And everything is really just done from a command center where folks just have to go out. Our staff just goes out to our facilities maybe once a week to keep an eye on things, to pick up any trash and do anything that needs to be done physically. But that the facilities run essentially with the kiosk unmanned without that human interaction. So there's a lot of ways that we can move the needle in a facility by reducing expenses and then increasing the income stream that's already in place. And obviously doing it in a quicker time frame by buying a facility versus developing. But on the development side, that's where we usually get a bigger pop. That's where we get the 2x and 3x return, although it does take us a little bit longer to get there, to get it completely out of the ground, built, and then stabilized at 80-85% occupancy, and all of those concessions burned off, and all of the ancillary income streams in place. So we do both. We like both.
Yeah, no, I would agree with that, Scott. And just, having that mix in your portfolio, right? If you're looking for that cash flow play, the value add is a little bit better. But if you don't need the cash flow right away, you can make more through an equity pop, right? If you make that investment, because essentially the investor is taking on a little bit more risk.
Correct.
With that, right? So you get compensated as an investor for that.
Absolutely, yeah.
One of the things I just love about this asset class is that, from an operational standpoint, I mean, anyone out there who has run a business before or even thought about, getting a business going, it's really amazing to know that you could have a couple hundred unit facility, and like you said, just being managed from a command center. With the advances in technology and what's going on. I mean, talk about a light footprint, really, from, an expense and operational standpoint. And then you have all of those levers to be able to manipulate, right, the income, your expenses, and really optimize that. And just to unpack what you said earlier as well, it's a really big difference to multifamily, is that you do have the ability to move rent on a monthly basis. Unlike multifamily, right, which is typically a year-long lease.
Yeah, for all those reasons and more, we love the asset class. It is just a very simple, predictable business model, which is good for me. I like the fact that also, this is a business in which, well, first of all, you need to treat it like a business. There are many folks out there that look at it as such a simple business that it's a hobby, and no business is a hobby, or else it's not a business. And you're not going to be able to, once again, be able to create that value unless you're walking the four corners of your business and constantly driving the performance. But we've been at this for a number of years. We've been in real estate for 30. I've been in storage for 18. We know the metrics, and we know how to, again, pull the levers, as you mentioned, and we know how much and how far and what it's going to cost, and how far we can usually create a change and affect the value of our facilities with those predictable moves, and because we know exactly what that looks like. Furthermore, we've been through a couple of recessions, and so we can see what's coming down the pike and see a little further down the road than other folks that have been in the business, whether it be in business in general or in real estate or in self-storage. And that allows us, once again, to be able to, keep our returns where they need to be, to look for any other potential issues or challenges a little further down the road, because we have that experience as well. And having that behind us has just allowed us to be able to pivot and move just a little bit in a more nimble fashion than even some of the big REITs, even though they have the experience. It just allows us to be able to make these decisions a little faster and be able to monitor the investment. We're also vertically integrated as well, which means that when we develop facilities, that's really the only piece that is outsourced. We don't have a construction team in place, although we do a lot of that in terms of heavy maintenance and some construction, but we leave that up to the general contractors. But property management, our fund management, investor relations, everything else is all kept in-house. That way we, once again, as anybody will tell you, nobody cares 1% as much about your property as you do. So in terms of property management, we're not working for fees on that side of the house. We're working to maximize the value of the investment and keep the expenses down in contrast. And so for that reason, we brought and developed our property management all in-house. And so everything, once again, is vertically integrated, so we can control those costs and better than any other third party would be able to do. And we have a more vested interest in maximizing the income as well.
Yeah, in addition to having a strong competitive differentiator.
100%. Yep.
And Scott, what do you think in terms of exit potential, right, with buyers? Just walk us through that a little bit. And if you have a particular sweet spot for asset sizes, right? Because I know in storage, you could get everything from, a 20 unit place to, 500 unit place, right? Is there kind of a sweet spot that you guys like to operate in? And then how is that impacted, right, on the back end when you move to exit? Do you have some bigger lever players that are buying the bigger ones and maybe doing a roll-up strategy, or who are your typical buyers?
Yes, all that. You hit the nail right on the head. And so what we're buying right now and what we're developing is institutional grade facilities. To the extent that we can get facilities that are 55,000 square feet and above. If it's an existing facility, we're trying to create that value by buying out, a B or a B minus, class B minus facility, and take it up to a B plus or A minus, developing nothing but class A institutional projects that would attract those institutional investors, whether it be funds or REITs or national players, regional players that would want to gobble up a portfolio or even individual facilities. But we have exited a number of projects and gone full cycle through the years. Last 2 years being very active in many of those projects, like Dave, you saw, and many others saw in 2020, 2021, where there were big funds, especially in self-storage. Heading into a recession, it was the most desirable asset class again. And so we had multiple exits, and we were selling some of our development projects at certificate of occupancy. As soon as they were built, we were selling them for a higher price tag than what our 5-year projection exit was when the entire project was full, leased up and stabilized. And so some of those we exited for obvious reasons, to take advantage of being able to roll that money over again and get a high IRR for our investors. And so we will now continue to do so and monitor that. But the goal is, almost, never say never, never say always, but almost every time that we exit with multiple projects at a bigger price tag, the multiple that we get in terms of a cap rate or an equity multiple is higher from these institutional investors they would rather deploy more capital on one transaction with multiple facilities, and they will pay a premium in order to do so for speed. Obviously, they're writing a check for speed if they're looking to grow, and it's just a less work altogether. So in order for us to be able to package those up and sell them, that is the most desirable way, and so that is the goal, and that is our strategy. We're seeing one of the beautiful things, another one of the beautiful things about our industry right now is that this is the last asset class, truly, that is on the wild, wild western front, if you will, because the other asset classes, being mobile home parks, multifamily, assisted living, dental practices and buildings, retail, hospitality, they're roughly 80% owned by the REITs or institutional investors, and maybe 10 to 20%, depending upon those asset classes, still owned by mom and pops, if you will, or smaller individual players. Whereas in self-storage, it's the opposite of that. Only 20% of the industry is owned by the REITs or the major players, and they are coming in full force, competing with us at the lower level. But they are our buyers, they are our customers. So as we grow these portfolios, or if we buy 3 or 4 projects within one locale, within one geographic area, we'll roll those up and maybe sell those up individually, or roll them up into the bigger package to be able to sell off. So we do have a fund, and we've also got different private placements and direct investments that have one property in it or multiple, as well as a larger fund that just, depending upon our exit and the strategy, determines where we'll put those projects and then ultimately how we will exit.
Makes perfect sense. Scott, if you could give our listeners just one piece of advice about how they could accelerate their wealth trajectory, what would it be?
Yeah. Well, first of all, I don't give advice. I'm not paid to, and nobody wants to hear advice. We have a rule around here where we only share experience. And the experience that I've seen is what most people have seen as well. It's when everybody else is running out is when you should be running back in, or at least looking to get back in, but doing your own due diligence and getting advisors around you or mentors. So whether you're investing passively or actively, as we head into this next economic cycle, and as you mentioned, Dave, many folks would say we're in it already, or we're heading into a recession. More millionaires were created, more successful businesses were started during a recession than any other time for a multitude of reasons, and that's usually because most things are on sale, and that includes real estate. And so the projects that we're bringing on right now are very strong. The returns that we're seeing when we come out on the backside of these are going to be incredible. And for any active investor or passive investor, I would just say that sitting on the sidelines is probably not the best place to be. And again, that's why I say this is I don't give advice. But if you just do the math, interest or the inflation rate right now, depending upon who you read, where you get your data from, and the numbers that you actually dial into. You could say it's at 6%, 9%, or the real numbers are closer to the mid-teens, 15 or 16%. If you're sitting on cash right now, you're losing money, and so eventually you've got to get in to get those returns again to fight off inflation. But the longer you stay in, now you really have a hole to dig yourself out of if you're looking to claw back the returns or the losses on cash just sitting on the sidelines. And so, if anything, if it's advice, I would say from experience, Dave, that if you're sitting in cash right now, that whether we're at the bottom or not, there's the investments out there that are producing returns that you shouldn't have to wait until what you feel or think is the bottom. That has never been, in my opinion, a smart strategy. I've made money in high interest rate environments when the roller coaster is going up, and on the way down, you just got to get your money into play. Period. That's my experience.
Yeah, 100%. That's great, Scott. Appreciate that wisdom. So it's been really great having you on the show today. If listeners would like to connect with you or learn more about what you're doing, what is the best place for them to reach out?
Yeah, for all things self-storage, go to selfstorageinvesting.com. And we've got all types of white papers on the industry about what we do. You can connect on the tabs to our passive investing opportunities and website. And we educate, we mentor, we do joint ventures, obviously syndications, as we've been chatting about, and also active investors that look to partner with folks as well. So for all things self-storage, it starts at selfstorageinvesting.com. And then if you just Google Scott Myers and self-storage, I think there's about 40,000 impressions on me and my brand out there. We're on all the socials, and you can find us anywhere.
Awesome, Scott. Really appreciate your time today and sharing your wisdom with the listeners, and look forward to connecting again soon.
All right. My pleasure, Dave. Thanks so much for having me.